Hello, everyone, and welcome back to Your Finance TV. Our Friday regular show is here with Jay Pelosky. How are you, Jay?
Good, Scott. How are you, buddy?
I'm fantastic. Going into Super Bowl weekend, how couldn't I be happier?
Indeed.
I could be happier because there's Six Nations rugby as well, but everyone's focused on the Super Bowl. But what we want to hear from you is about your musings this week, and I love the title, Wall Street's Failure of Imagination. Now, I agree with you here because sometimes they don't have a lot of imagination, but please run me through your thoughts on this title.
Yeah, it came to me over the last couple of days, and I actually in the musings kind of lead in as a counterpoint with a classic line from a classic movie. And I'm going to test you on the movie here in a second, so get ready. But here's the line. What we've got here is failure to communicate.
Yep,
It's the movie.
it's Cool Hand Luke.
Cool Hand Luke,
How many
exactly.
eggs do you get? 30 or 50?
I don't know, but
Ah,
it's classic. So that line came to me as well. But in Wall Street, of course, we don't have a failure to communicate. I mean, look at us. We're communicating right now. There's tons of communication. Wall Street's failure is worse, namely a failure of imagination. And, I'm not sure where it started or how it began. My own view, having been in the business now, God forbid, coming up on almost 40 years, is that it really began when the pension funds moved into allocation to hedge funds. And they basically threw bags of cash at the hedge fund community, but told them they wanted high single digit returns with low volatility. So they really took away the aggressive hedge fund types who would be looking for double digit returns but have more volatility. And so that was really the end of the hedge fund world. And if you look, hedge fund openings have collapsed over the last couple of years. The money's just too good, right? When you're talking about pension fund money, as opposed to wealthy doctors and dentists and wealthy individuals funding you, it's a different game. And then more recently, and this is just in the last year or two, you can pick up any paper or any link, click on any link, and hear about how passive dumb money is overwhelming active managers. And David Einhorn was just on the tape yesterday, I believe, saying that markets are fundamentally broken, namely that there's the dead weight of passive money is killing the markets. And I have to say, I have a different point of view, which is that, have you looked at how poorly active managers have performed over the last couple of years? Do you remember last year, 100% odds of a recession? Do you remember Wall Street predicting that the S&P would end down in 2023? What happened? We ended up with 3% GDP growth, and I think the S&P was up close to 23 or 24% last year. And those are the things that have caused the end of active management. And it really is reflecting, in my view, a failure of imagination. The failure to move away from models that didn't have any kind of a global pandemic built into them. We've been in an ahistorical period since COVID, since 2020, which is now rapidly coming up on 4 years ago. And so if you're using models to kind of guide you, and much of Wall Street today, certainly the majority of daily trading is model driven, algorithmic trading, and it doesn't have a pandemic in it, which they don't because the data is not good enough to incorporate the 1918 and 1920 period, then you're at sea. And so many people, so many investors these days just aren't comfortable, going off script or going off the model. And so as a result, to me, I end up on this little bit of a kick saying that Wall Street has really kind of become a CYA business where it's okay to fail as long as you fail when others are failing, right? So the fact that you're an active manager and the active managers have massively underperformed, you're okay because, hey, you're with everybody else. And it's really not worth it. The economics, the politics, the setup is not really worth it to push against the consensus. And that's why I think that most of the people who have been right over the last couple of years have been independent shops, not big firms, not big hedge funds. You know, you think of Tom Lee at Fundstrat, right? Used to be at JP Morgan, out on his own. Been about the most accurate guy over the last couple of years. Ed Yardini is another one. The guys at the Carson Group, another group. So, you know, I think there's a lot to be said for that, you know, independent nature, willing to kind of strike out on your own and look at the world in a different fashion. So a failure of imagination, a failure of forward thinking has left a lot of Wall Street underperforming.
Okay, well, listen, I get it. I understand like the fun side of it. Like they've also had margin pressures and all that sort of side of it. But give me some examples of Wall Street's failure of imagination.
Right on time, right on cue. I give three in the musings. The first is the 2024 consensus GDP outlook is for 1.4% growth in the US. That's after we had 3% growth last year, and the Atlanta Fed's GDP nowcast is tracking for Q1 2024 about 3.5%. So that number is without a doubt going to be revised up. The second is the average target for the year-end S&P is roughly 48. Let me get it exactly. The average is 48.61. Well, guess what? We're over 5,000 right now, and it's not even the middle of February. And so again, a failure of imagination. You know, just kind of blindly saying, okay, we're going to have very low growth, 1.4%. We're going to have, therefore, very limited market upside because we had a 20% plus move over the course of 2023. And therefore, let's give the year-end target of 3% upside or something like that. And then the third is how people are kind of tying the Magnificent Seven in the AI revolution to the dot-com boom bust of the late 90s and calling Nvidia the Cisco of today's age. And I think those comparisons don't even stand up to the most cursory examination. And it's really quite simple. Dot-com had very limited earnings growth, very limited money, right? It was all speculation. You would just put in .com and IPO it and the money would flow in. Versus today's Magnificent Seven are cash generating machines. And the operating margin for the tech sector has more than doubled since the late 90s. It was at that time about 8 to 10%. Today, it's currently around 25%. And that's why you see these companies, you know, going up 30%, 40% on when they report, because Wall Street just is not factored in, no imagination, factoring in how quickly AI is shifting and driving things. And so when to end up, you look at Nvidia in the comparison with Cisco. I mean, it's just crazy. Nvidia is the AI poster child. And it's almost, I make the analogy, it's like going to the casino. If you want to go to the casino, you have to have chips. And AI provides the chips. And the clearest indication of this to me was when Sam Altman of OpenAI came out and said that they want to raise $10 to $15 billion to set up their own foundries, because he understands better than anyone that if you don't have the chips, you're not going to get a seat at the table. And so Nvidia and Cisco is just apples and oranges, not even close in terms of comparisons.
Well, I've got a stat for you on Nvidia, which I saw from MarketWatch today. Nvidia is now worth as much as the entire Chinese stock market.
Well, I mean, that suggests that can suggest many things, including our view which is that the China market at this point is extremely undervalued. And you can maybe argue, and we know valuation is not a particularly good timing indicator. It ultimately is important, but it's not a great model for timing in and out. Things can get extended, things can get overly cheap. I would say at this point, maybe Nvidia is a little expensive, but the point that we've made in the past is that today Nvidia trades at about 25 times earnings versus a 5-year average PE multiple of over 40. So arguably, it's as cheap as it's been at any point in the last 5 years, just as the AI revolution is really starting to gather pace. And then on the other hand, we'll get to China at the end perhaps, but China sells at 8 times forward earnings with consensus earnings growth of about 14%. Uber cheap, but we can talk about that in a little bit.
Yeah, we can talk about Uber another time as well.
Yes, exactly. Another that's an example of imagination and execution actually coming together to provide and present a real opportunity. And kudos to the management team at Uber because they've done a great job the last couple of years.
You should watch that Netflix show, and it's actually really good. All right, talking about some other things to look at. We talk often about your macro surprises, your 4 macro surprises. Do you have any updates on that for us?
Yeah, we talk about the 4 for 24, right? The 4 macro surprises we introduced back in October when we wrote our 2024 outlook. And they're all working according to plan. Number 1, lower inflation sooner than expected. Next week's CPI, we expect the headline to be under 3. That will be the first time in 3 years that we've had a CPI under 3% on the headline. The second is better than expected productivity. And productivity growth in the U.S. is key. This is critical. It's growing the last 3 quarters. Average on an annualized basis about 3.9%. The last time the U.S. had productivity growth of 3% for any length of time was in the second half of the 90s. And that has been and remains the analog for us. We think we're going into a period of years that will be akin to the second half of the 90s, with the main difference being it's going to be global this time, not simply U.S. centric. And then the third surprise is the return to stability, again, manifesting itself. If you look at the VIX, if you look at the MOVE index for bonds, we think we're coming out of a period of pandemic-related chaos and moving into a multi-year period of macro stability. And that leads us to our fourth point, which is the evidence really starting to pile up. And that is that we're early cycle in a global economic recovery, not late cycle going into recession. And let me just reel off a couple of data points to support this idea of early cycle. The first is the semiconductor. We just talked about Nvidia, AI, and chips, semiconductor cycle turning. The second is the housing market in the U.S. turning and picking back up. The third is new orders in the ISM manufacturing index breaking above 50 for the first time in a year and a half. And the fourth is the pickup in Asian export orders. This is a traditional macro tell. South Korea exports up 18% year over year in January. Vietnam's exports up 42% year over year in January. So the world's factories, the Asian manufacturing cycle is starting to pick up, and we expect that to manifest in the U.S. manufacturing cycle here in the next couple of months. And so our view really is coalescing around the idea that because of how fast the 4 for 24 macro surprises are manifesting, we're not even midway through the second month of the year, and the data is coming through on all 4 of these things, that we are now starting to talk about a multi-year period of positive economic activity, underpinned by a rate cutting cycle, global rate cutting cycle, abundant global liquidity, rising productivity, a CapEx boom to deal with the regionalization of supply chains, COVID, climate, and conflict. All of these things culminating in solid earnings growth and underpinned again by that huge amount of money that has moved into the money market fund complex during these years of uncertainty, right? Well north of $6 trillion, $6 trillion in U.S. money market fund complex. And so we expect as that stability manifests, as this better than expected, as we utilize our imagination to think about the future and kind of blue sky the future, we kind of see this environment setting up where you're going to have significant tailwind of cash moving out of what will be perceived to be relatively low yielding cash, let's call it 3 to 4%, as we go through a cutting cycle, versus equities, potentially, particularly outside the US, with double-digit type return opportunities attached to them.
Okay, well, some great insights and thoughts about what's going ahead. And obviously, we just did our monthly, your monthly, I should say, last week. If you haven't seen that video, make sure you go to the YourFinanceTV homepage. You'll find that. So obviously, make some updates to your model portfolio. Can you give us any insights into that?
Yes, we did. As you accurately point out, our process is that we write the musings every Friday, first 3 Fridays of the month. The monthly big deep dive, last week's monthly was 6,500 words with 30 charts and tables. That gets us all our ducks in a row, so to speak. And then the next week, which is this week, we update our models. Remember, we have the two, our global multi-asset model, which looks at stocks, bonds, and commodities around the world, and our TPW20, which is a thematic focus model, really concentrating on future tech innovation and clean energy are the two main drivers there. And so as we go through that updating process, we look at a lot of charts and tables. And a couple of quick kind of takeaways. One is that the strength of this US move over the last 3 months, near 20% type move, very unusual, typically only seen coming into expansion, not going into recession, an important point to bring out. So powerful that it's really lifted the rest of the world as well. So you have not only the S&P at new all-time highs, you have ACWI, which is the global equity index, at all-time highs, and it's even been able to drag the emerging market index, EEM, above its 200-day resistance level, and that's with China being a 25% weighting in EEM. So that was one kind of broad market takeaway. The second is we paid real close attention to the relationship between TLT, which is a long duration US Treasury ETF, and GSG, which is the Goldman Sachs Commodity Index ETF. And what we noticed is that TLT is breaking under its 200-day support, never a good thing. And GSG is breaking up and out above what has been 200-day resistance. And so this is, in our view, is confirming this acceleration of growth that we are making the case in our whole early cycle work. We're accelerating, not decelerating on a global basis. And if TLT sustains that breakdown and GSG sustains that breakout, that is going to confirm our thinking. And so as we go through the model, we looked hard at China, obviously, because China has been the one sticking point for us. It's the thing that hasn't worked. But when we look at China today, it looks a lot like the US 3 months ago. In other words, sentiment is horrible. Seasonality is good. Typically, China does pretty well around the Lunar New Year. Positioning is completely empty. Everyone's out. And the technicals are quite strong. In fact, Renmac just reported that its trend model issued a capitulation signal on Chinese equities last week. And so with that, we're thinking we're going to stay with our China exposure, which is primarily in the K-Web and the tech side. And then the other thought that we've had that we put into play was everyone talks about the Magnificent Seven in the US. Well, there's a Magnificent Six in the non-US developed markets that can be expressed in an EFA growth ETF that's available. And it has a combination. It's not as tech heavy. It's got some tech like ASML from the Holland, SAP from Germany, and it's also got some medical with Novo Nordisk in there, and it's got some automotive with Toyota, which is really doing very, very well in the auto side. Just had record results last week. Stock was up 5%, I believe, on the earnings. So it's a nice mix, and we think that basically the rest of the world is going to come along behind the United States. And while the U.S. rests at some point, right, the S&P is going to take a rest, probably pull back a little bit, digest some of the gains we've had, all perfectly normal behavior. The rest of the world can probably continue to keep going, given that we think it's behind the U.S. in terms of the growth recovery. And so that's really what we're doing, as we've been talking about, looking elsewhere for the action. We made our bets in the U.S. in November. We've kept them. They've done perfectly well, and we expect to continue to hold those positions. But now we're looking for the next move up, and we think that's quite possibly going to be found outside the U.S.
Okay, well, listen, Jake, thank you so much for that. It's also, don't forget, China's closed next week. It's the Chinese New Year, Year of the Dragon. What we all want to know is what's your pick for this weekend?
You know, I was on Bloomberg this morning earlier at the very early hour of 7 a.m. And they asked the same question, and I threw out the Niners. And so I think that's where my heart is. It's awfully tough to go against Mahomes and the Chiefs, but I think the Niners are really hungry, and I'm hoping for a good game, and certainly plan to be, planted in front of the TV on Sunday night around 6:30 for the duration. Hopefully, it's going to be a good game. I think it should be.
Fingers crossed.
You? Do you have a
good game as well. I think Chiefs 31-21.
Yeah, 31. Wow. Okay. Yeah, I mean, from what I've read, the big issue is going to be the Niners' run defense against the Chiefs with their strong running game. And then also the fact that the Chiefs have a much better defense than they traditionally have had. And we'll see if Brock Purdy can really do the job as a young quarterback. That's the other thing with the Niners. You're talking about not a rookie, but effectively first-year starter at quarterback for the Niners versus Mahomes for the Chiefs. And that's, again, that's kind of a matchup that you would think would favor Kansas City. So not surprised you're going with Kansas City. I think Kansas City is favored. But I would like to see the Niners, break through and finally capture the W.
I'm looking forward to a good game. Jay, enjoy the game. Until next week, have a good one.
Thank you. You too, Scott.
And for everyone else out there, good luck investing.